Hi, I'm TJ Doyle, Director of Social Media here at NAR, with NAR Chief Economist Lawrence Yun to discuss the 2015 housing expectations. Lawrence, home sales we saw were down about 3% in 2014 with a month of data still to go. Home prices up 5 or 6%. What are you seeing overall for your 2015 expectations?
So 2014, I think broadly speaking, one can say that it was a decent year, not a great year, because we saw some sales activity down, but home prices continue to move up. Most homeowners are not in the market, so they are focused only on home prices, and that has been doing well throughout 2014. Now going into 2015, broadly speaking, I anticipate the improvement, continuing improvement in home prices. Home prices to rise roughly 5%. Home sales, I believe there is a sizable pent-up demand that could be released into the market. So home sales are anticipated to rise about 7%. Now the new home sale, newly constructed home sales could rise 30 to 40%. Huge percentage gain. But however, the caveat is that new home sales really has been struggling to come back around. So this is a delayed recovery in the new home sales market. And even with that big percentage gain, they would essentially be coming only back to half the normal new home sales pace.
If we can dig a little deeper into these 2015 expectations and maybe break it into two parts, the overall economy, what are you seeing there? Where are those indicators headed?
The economy is now beginning to burst out. Generally speaking, GDP growth, that's the measurement of the total production in the U.S., historical average is 3%. So if anything is above 3%, one is saying fantastic. Below 3%, one is saying sluggish. And if it's a negative, one says it's a recession. Well, the latest 2 quarters of GDP data is better than 4%. So it's beginning to burst out. Very encouraging, and the result of that is jobs, jobs, jobs. Now job creation is reaching above 2.5 million on a 12-month basis. So it used to be about 1 million a year, maybe 2 million a year. Now it looks like 2.5 million or possibly even 3 million a year. So jobs are beginning to also burst out. The negative, one thing that is not bursting out is wages. Wage growth, it appears to be stuck at 2% for now, but with the unemployment rate beginning to steadily go down, it's possible that we may begin to see some wage bump towards the second half of the year. But the wage growth has been still a disappointment related to the economy, even though we are creating jobs.
Anything you want to add perhaps on monetary policy or the 10-year treasury, some of those other economic figures that can affect the marketplace?
Well, the monetary policy has been very accommodating to help push the economy forward. The ultra loose monetary policy of zero interest rate policy on the short-term interbanking lending rate, as well as something called quantitative easing, which is essentially printing a lot of money to help pump the money into the economy. So this has resulted in low interest rate environment. The mortgage rates are at a historic low because of the loose monetary policy. The other borrowing costs are also very low. Now, interesting fact is that generally people associate loose monetary policy, printing of the money, with higher inflation and weakening in the dollar. That would be the economic textbook explanation as to how the economy moves. But the reality in today's economy is that inflation is not popping out. Inflation will remain very subdued. Recent decline in gasoline prices are very helpful. And the other part is dollar is actually strengthening because even though the U.S. economy, aside from recent quarters, was still a sluggish expansion. So one would have thought that U.S. economy being somewhat sluggish, the dollar would be weaker. But the other countries' economy is in worse shape. So the Europe is essentially not growing. Russia going into recession. China growth rate has greatly slowed. Japan stalled. So comparatively speaking, the U.S. economy is doing better, and hence the dollar has strengthened.
Now on to the housing-related specifics. What do you see occurring with sales, with price, with inventory?
Well, the home prices have risen for the past 3 years, cumulatively about 25%. And the way I view this is, first, it boosts people's confidence about the market. So home purchase is a major expenditure. People would not want to buy a depreciating asset, so they want to see some appreciation. So consistent appreciation will give confidence. The second factor is that many homeowners, now they're beginning to see equity buildup, and traditionally they have used this equity buildup as a down payment for their next home purchase. So the fact that the rising home value is leading to equity buildup and they can use that for down payment, very positive news. However, so far in the housing market recovery, the group of people who have been missing in action are the first-time buyers. They have struggled to come into the market, but there is some indication that recent data is implying that maybe the first-time buyer percentage is beginning to slowly turn for the better. Improving economy certainly helps, and you have now a change in mortgage products that is available in the marketplace, including 3% down payment product along with private mortgage insurance. So we may begin to see some upswing in the first-time buyer coming in. And now, one thing to note is that the number of distressed property sales has greatly diminished. This is from rising home value as well as many of the institutional investors having gobbled up those foreclosed properties. So there's very little left of the distressed property, which means that home values will certainly rise given that there's far fewer distressed property sales. So another boost to consumer confidence about home purchase.
Overall, it seems like we're talking about a relatively positive picture for 2015, but with any level of expectations, there's variables that are unforeseen. What sort of speed bumps could we possibly see in 2015 to affect these projections?
The mortgage rate will certainly be rising, and I anticipate that mortgage rate possibly could hit 5% average by the year end. The current rate is closer to 4%. But 5% is still historically very favorable levels. I don't think it will be damaging, but for some people, maybe they are very sensitive to mortgage rates. The other speed bump is that even though there is a lot of discussion about the possible relaxation in underwriting standards back towards more normalcy, we don't want to have any lax underwriting standards, but just move from stringency to more towards normal levels. So there's much discussion of it, but it's really up to the lenders to make those loans. So it still remains to be seen whether or not lenders begins to, through competition, more mortgage product comes to the market. But if the underwriting standards continue to remain stringent, that will hold back first-time buyers. And the first-time buyers not participating means that chain reaction. First-time buyers buy, therefore it releases the trade-up buyers to buy the next home, and so forth. That chain reaction may not be occurring to the degree that it could. So that is another potential speed bump. And the other factor is more coming from the academic studies. And I'm not sure how much we should take from this academic study, which is implying that the lock-in effect of low interest rates. That is to say, many homeowners right now have comfortable 4% mortgage rates. With mortgage rate rising, are they willing to trade up to buy a next home, even though now they would have to give up that low interest rate and take on slightly higher mortgage rates? My view of the data suggests that most people move based on changes in family circumstances, getting married, people want to have a home, having an additional child, they need an additional larger size home. School-age kid, they are looking for better school district. Job changes, they are looking to be in a shorter commute. So those lifestyle changes will drive home sales, but let's see how much of a lock-in effect it holds back some of the home sales growth.
Lawrence, thank you for your time. It's a pleasure as always to speak with you, and I look forward to doing our next video in 2015.
Thank you.